Welcome back to the deep dive. Today, we are really cracking open one of the most crucial areas of business performance. And it's one that, frankly, can be pretty misunderstood. We're talking about how companies truly calculate what things cost. We're going way past simple addition and subtraction here. Instead, we're diving deep into, well, the architecture of modern management accounting. Our main goal today, our objective, is to zero in on a really major shift in how businesses absorb costs. It's quite fundamental. We need to frame let's call it the traditional approach first, the familiar marginal and absorption costing methods, and then right away place that side by side with this more disruptive methodology, activity-based costing, ABC. Because this isn't just about learning new terms. It's really about understanding why those simple metrics, the ones that maybe worked fine in the 1950s, why they fail, sometimes spectacularly, actually, in today's complex, often service-driven global economy.
That's absolutely right. Yeah. Think of this whole analysis as giving you the key foundational structure for performance management. It really is the bedrock. For decades, companies relied heavily on volume metrics. Things like how many units did we make? How many labor hours were clocked? Simple stuff. But then overhead costs just exploded. They became dominated by, R&D, IT infrastructure, complex logistics, and that old system, it just couldn't handle it accurately anymore. It started to distort things. So we really need to understand the tools, the methods that fix that cost distortion. That's what we're getting into.
Okay, right. Let's unpack this then and start with that foundational framework you mentioned because, every discussion about costing, it seems, has to begin by defining the scope of management accounting itself. Where does it fit?
It's the critical starting line, definitely. We often see management accounting sort of lumped in with financial accounting, but they look in completely different directions. Financial accounting, you see, looks backward and outward. It's historical data, it's strictly regulated, and it's mainly intended for external people, shareholders, tax authorities, banks.
Right, the official reports.
Yeah.
But management accounting,
Yeah.
that looks inward and forward.
Exactly. Inward and forward. It provides the custom, often real-time data that internal managers need to actually navigate the business day to day, week to week.
Okay.
And nestled right in the middle of that internal focus, that's where you find cost accounting. This is the specific branch that really concerns itself with the nitty-gritty, the detailed recording, the classification, and crucially, the accurate summarization of costs. It's like the engine room,
Yeah.
generating that raw data.
Okay, so cost accounting generates the data, the raw material. What does management ultimately build with it? What's the point?
Good question. The ultimate function of management accounting, what everything really hinges on, is supporting planning, control, and decision-making. These three. So if you're building a budget, that's planning. If you're tracking how you're doing against that budget, looking at variances, that's control. Or if you're deciding something big, like whether to drop a product line or invest in new tech, that's decision-making. And all three rely completely, utterly on the accuracy of your cost data. What's fascinating here, and maybe a bit scary, is how immediately fragile that whole structure becomes if the costing methods are wrong, just fundamentally flawed. If we rely on outdated or distorted cost figures, which, as we're about to see, traditional methods often generate, then every single planning cycle, every control mechanism we put in place, and every crucial decision we make is potentially fundamentally misinformed, built on shaky ground.
Wow, okay. That sets the stage perfectly then for revisiting the past. Before we jump into the modern solution, ABC, we need to revise those two pillars of traditional costing that most businesses, or at least business students, learned first. We're talking about marginal costing and absorption costing. And these two methods, they're different, but they often rely on these conventional, sometimes quite simplified, and usually volume-based methods for handling overhead costs, right, for absorbing them.
Exactly. Think of this comparison as the sort of original debate in the costing world. Marginal costing is conceptually pretty simple. It says only the variable costs, so direct materials, direct labor, variable overhead, only those count as the cost of the product itself. Fixed overheads, things like the factory rent or the manager's salary or insurance, those are treated as period costs. They just get expensed immediately in the period they happen.
Okay, straight to the bottom line for fixed cost.
Right. Absorption costing, on the other hand, takes a different view. It says, no, wait, the product has to absorb a fair share of all the manufacturing costs, both fixed and variable. So it attempts to allocate those fixed manufacturing overheads to the units produced, usually using some kind of conventional absorption rate, like per labor hour or machine hour.
Okay, so if they're both methods for calculating cost, why do they give us different answers? The different profit figures sometimes.
Because of that fundamental difference in treating fixed overhead. It's all about that. Imagine you run a plant, right? And you pay, say, just $10,000 in fixed rent every single month. It doesn't change with production volume. Now, if you use marginal costing, that $10,000 hits your income statement immediately that month. Boom, period cost. But if you use absorption costing, you take that $10,000 and you allocate it, spread it across all the units you produce that month.
So part of the rent cost ends up in the cost of each unit.
Precisely. And this creates a really critical difference in reported profit, especially when your inventory levels fluctuate when you produce more than you sell, or vice versa. See, if you produce more units than you actually sell in a period, under absorption costing, some of those fixed costs, that rent money, get deferred. They become part of the value of the inventory sitting there on the warehouse shelf. They don't hit the income statement yet. Marginal costing, remember, expenses all fixed costs right away.
So wait a minute, absorption costing could actually report higher profits just by overproducing stuff and letting it sit in inventory.
Exactly. That's the big danger.
That seems kind of misleading, doesn't it? Almost like it could hide inefficiency or encourage building up unwanted stock. It feels inherently flawed for good internal decision making.
It absolutely can be. And that's a massive red flag for performance analysis. Managers might look good short-term just by cranking out units, even if nobody's buying them. That's why management teams often prefer to use marginal costing data for certain short-term tactical decisions, things like accepting a special order at a lower price. In that case, you really only care if the price covers the extra variable cost of making it. The fixed costs are happening anyway.
Okay, that makes sense for specific scenarios.
But the bigger problem, really for both methods, but especially acute for absorption costing, is how they handle that overhead allocation in the first place, even beyond the inventory issue.
Right, that allocation problem you mentioned, spreading the fixed costs.
Exactly. Absorption costing traditionally uses a single, usually volume-based driver to spread all that complex fixed overhead across all the different products. This single conventional rate, it might be based on total direct labor hours for the factory or total machine hours run, something simple and measurable. But think about what that assumes. It assumes that if a product takes twice the direct labor hours to make, then it should also automatically get twice the share of all the factory's support costs, the quality control inspections, the engineering support time, the maintenance scheduling effort, the purchasing department's work, everything.
But in the real world, surely the production volume, like labor hours, often has very little to do with what actually drives those complex support costs.
Precisely. You've hit the nail on the head. That's the core weakness. Imagine you have two products. Product A is simple, standardized, churned out in huge volumes. Product B is complex, maybe custom-made, produced in small batches. Under traditional absorption costing, using labor hours, the high-volume product A ends up absorbing a massive chunk of the overhead costs, simply because it uses a lot of labor hours overall, even if it barely uses any complex engineering support or specialized quality checks. Meanwhile, the complex, low-volume product B, which might actually be causing most of the engineering headaches and setup costs, gets relatively little overhead allocated to it.
So the simple product effectively subsidizes the complex one.
Yes. The system assumes the only thing that drives cost is volume, and that leads to massive cost distortion. Product A looks less profitable than it is, and product B looks more profitable. And that distortion, that fundamental weakness in handling overhead based purely on volume, that's what brings us directly to the modern solution.
Okay, here's where it gets really interesting then. Activity-based costing, or ABC. This is the sophisticated method we need to compare directly against those traditional approaches and their kind of crude overhead absorption techniques.
Absolutely. ABC really arose out of necessity, mostly starting in the 1980s. It was a response to manufacturing becoming more complex. Product lines diversified, you had more customization, and crucially, indirect or overhead costs began to absolutely dwarf direct labor costs in many industries. The old system just broke down. ABC's core aim is conceptually simple, though. If costs aren't truly driven by production volume, they must be driven by activity. So, the whole concept starts by viewing the company not as one giant cost center or maybe a few departmental ones, but as a collection of specific activities, things the company does, like placing a purchase order, setting up a machine for a production run, inspecting a finished product, processing a customer return. These are all activities, and ABC aims to allocate overhead costs much more accurately by recognizing that different products or services or even customers consume these supporting activities at vastly different rates. It's not uniform.
Okay, if activity is the key, how do we actually measure the consumption of these activities? That's where this concept of cost drivers comes in, right? This sounds like the absolute core of the ABC model. Getting this right seems critical.
It absolutely is. You can think of it as finding the root cause in cost accounting. The cost driver is the specific factor that measures the consumption of an activity. It basically answers the question, what causes this particular cost pool to be incurred? Why does this activity happen? So instead of using just one single factory-wide driver for everything, like total machine hours, ABC identifies multiple specific cost drivers, each linked to a specific activity or group of related activities, a cost pool.
You give example.
Sure. Let's say one activity is machine setup, the cost associated with setting up machines, the technician's time, the materials used, etc. What drives that cost? It's not total production volume, it's a number of setups performed. That's the cost driver. Or take customer order processing. The costs of that department, salaries, computers, supplies. What drives it? Probably the number of customer orders processed. Not the total value of the orders, perhaps, but the sheer quantity.
Ah, I see. So we shift from measuring just output volume to measuring the complexity and the diversity of the tasks needed to actually support that output.
Exactly. Complexity and diversity. That's a great way to put it.
Could you maybe give us an example that moves beyond the traditional factory floor? Because so much overhead today isn't really driven by machines anymore.
Oh, absolutely. Great point. Think about a software company. Traditional costing might try to allocate all the IT infrastructure and central support overhead based on something simple like programmer labor hours. But that completely ignores the complexity. Let's say they offer 50 different microservices, each needing server space, monitoring, patching, maybe specific support protocols. The real cost of managing that server infrastructure isn't driven by how long a programmer codes on any one service. It's probably driven by, say, the number of server clusters maintained. Or the cost of specialized customer support for complex issues might be driven by the number of Tier 3 support tickets processed, not just total customers. Those become the true cost drivers in that environment. Much more accurate.
Okay, that makes it much clearer. So following on from that, the specific sequential steps that are required to actually implement ABC, they aren't just like bureaucratic hurdles. They are really essential for mapping that cost flow accurately using these drivers.
Yes, they are entirely procedural, and each step builds on the last. It's quite logical. First, you have to identify all the major activities performed within the organization. What do people actually do? Second, you assign the costs incurred to these activities, grouping related costs into what are called cost pools. So all costs related to procurement might go into the procurement cost pool. Third, and this is crucial, you determine the appropriate cost driver for each cost pool. What measures the consumption of that pool's activity? And then finally, you calculate a rate per driver unit, like cost per machine setup or cost per purchase order. And you use that rate to assign the overhead cost to the actual cost objects, the products, the services, the customers, based on how many units of the cost driver they actually consumed.
Okay, I have to ask the obvious question here, though. Isn't collecting all that super granular data, tracking every single little activity in its driver, isn't that just, well, overkill sometimes? It sounds incredibly complex and potentially very costly to set up and maintain.
And that is the essential critique. That's absolutely fair. And it comes up whenever we do an analysis of ABC. You've hit on its primary limitation. The upfront cost, the complexity of identifying all the activities and drivers accurately, setting up the data collection systems, maintaining them, it can be significant. Absolutely. It requires real management buy-in, dedicated resources, good information systems. For a very simple company, maybe one that makes just one or two very similar products, it might honestly not be worth the trouble. The distortion from traditional methods might be small anyway.
Fair enough.
However, the payoff, the benefit in highly complex environments, where overhead costs are huge, maybe the majority of total costs, and where product or service diversity is really high. In those situations, the benefits can be absolutely unparalleled. You get hyper-accurate product or service costs. Finally, you gain much, much better insight into exactly where your resources are being consumed, which activities are eating up the money, and importantly, it helps you spot non-value-added activities, things you're spending money on that don't actually contribute value to the customer or the product. That allows management to streamline processes, cut waste, and of course make truly informed strategic decisions about pricing, about which products or customers are actually profitable, where to invest, where to cut back.
Right, so this really brings us back to the core objective we set out with. The comparison required between ABC and the conventional methods is, well, it's crystal clear now, isn't it? Conventional overhead absorption, the kind used by traditional absorption costing, relies mostly on a single volume-based assumption. It simplifies the complexity, often incorrectly. ABC, on the other hand, completely rejects that simplification. It insists on defining costs based on specific activities and finding multiple appropriate cost drivers for those activities.
Exactly, you've got it. It's fundamentally the difference between, say, using one big bucket to try and capture the average rainfall for a whole city versus using specific individual rain gauges placed in every single neighborhood. Those gauges tell you exactly how much water fell right there. And it's that granular, specific data from the rain gauges, the cost drivers, that gives you the information needed for precise resource management and accurate understanding. The big bucket just gives you a potentially misleading average.
That's a great analogy. Okay, so what does this all mean for you listening in? Let's try and summarize. We've established the foundational scope of management accounting, its internal focus, its role in planning, control, decision-making. Crucial groundwork. We've also critically revised those two pillars of traditional costing, marginal and absorption. We've seen their vulnerability, especially absorption costing, to cost distortion because they often rely on overly simple conventional ways to absorb overhead, usually based on volume. And then finally, we've broken down the modern alternative, activity-based costing, ABC. We've seen how its focus on activities and identifying true cost drivers through a structured steps process directly addresses those weaknesses.
Yeah, the key takeaway, I think, is the mechanism of that shift. It's profound. We're moving the whole basis of cost allocation away from just asking, how much stuff do we make? And moving it towards asking, what specific things did we actually do to support making that stuff or delivering that service? Understanding that fundamental difference in perspective, volume versus activity, that's probably the most valuable piece of knowledge to gain from this deep dive.
Okay, building on that, especially on the focus on cost drivers, here's the final provocative thought for you to maybe consider after this. If the real power of ABC lies in identifying the true drivers of cost in complex situations, what happens when the product itself is almost entirely intangible? Think about it. The really big real-world challenge today isn't just applying ABC neatly in a factory anymore. It's applying these principles effectively in pure service environments. Think about digital marketing agencies, specialized legal or consulting firms, high-level biomedical research labs, identifying the meaningful activity drivers in those non-manufacturing operations. Is it, I don't know, number of unique client strategies brainstormed? The complexity level of regulatory compliance checked? Figuring that out, finding the right drivers for intangible work, that is where the really sophisticated application of this knowledge, the stuff we've talked about today, truly begins. Something to mull over.